Let's see a problem on consolidated financial statement. You are given two balance sheets as on 31/3/2012. Okay, and these balance sheets basically are of two companies, RAM Limited and Sham Limited. So on the asset side, you have various assets, namely land, plant and machinery, furniture and fixtures, miscellaneous assets, and investments. Shares in Sham Limited. So basically, RAM Limited holds shares in Sham Limited. So if we just want to keep this in mind, we can just draw the small chart: RAM Limited, Sham Limited. And there are 3,000 shares that they own. Right? On the liability side, you have sundry creditors, you have profit and loss account, and you have equity shares. Okay, very good. Sham Limited became a subsidiary of RAM Limited on April 1, 2011. So April 1, 2011 is when it became a subsidiary, and we have the balance sheet as on 31/3/2012. When the balance in profit and loss account was 20,000. So on the date of acquisition, the profit and loss balance was 20,000. Prepare a consolidated balance sheet of RAM Limited. So you are required to prepare consolidated balance sheet of RAM Limited. Now before we start, let me just give you some understanding as to how basically the consolidated financial statements work. Now normally in a consolidated financial statement, there are certain aspects that you need to bear in mind. Right? The first aspect is that there is certain set of assets which are owned by both companies, or let's say even assets and liabilities. So there will be a certain set of assets and liabilities which are owned by both the companies and on which there is no adjustment which is required. There is no adjustment to be made. Okay. The second thing which is important as you prepare the consolidated financial statement is what is the cost of control or goodwill stroke capital reserve. Now you must be wondering what devil is this. I'll come back to it. And the third is the profit allocation pre-acquisition, post-acquisition. Okay. So the first one is very simple actually, which is the set of assets and liabilities which are owned by both the companies, but there is no adjustment which is required. Okay, we'll take them one by one. So let's cover the first aspect first. So I'll move on to the next page to draw a balance sheet. So we are basically making a balance sheet of RAM Limited. So balance sheet of RAM Limited as on 31/3/2012. This is the amount column. Assets, amount, liabilities, amount. Right? Let's go back. So what was the first thing that I said is relevant? The first thing which is relevant is assets stroke liabilities which are owned by both the companies but no adjustment required. So let's say there is land which is owned by both the companies. Ram Limited owns it for 30,000, Sham Limited owns it for 20,000, right? So what do? We make a total of the land 30,000 for Ram and Sham 20,000. Take the sum, put it in the outer column. There is no adjustment which is required here, right? As a habit, try to do it like this. The moment you complete one adjustment, just mark a click on it. Okay, this will ensure that you don't need to come back and revisit it. At the same time, once the balance sheet is completely done, you will also ensure that you haven't forgot anything. Furniture, plant and machinery, 8,000 for Ram, 37,000 for Sham. Plant and machinery. Ram 8,000, Sham 37,000. There is no adjustment in any of these items, right? So again a tick. Furniture and fixtures 20,000, 25,000. No adjustment, so we will just put up this amount and move on. Right? It's very simple until here. Then miscellaneous assets, tangible 21,000 and 14,000. Again no adjustment, so we will just do a sum total and put it here. Miscellaneous asset, how much was it? 21,000 and 14,000. Just doing the total of it. No rocket science, just putting in the numbers. Now comes the investment. Shares in Sham Limited 3,000 shares. Now what is the total share capital of Sham Limited? Total share capital is 50,000 rupees. And equity share are of 10 each. So how many equity shares are there in Sham Limited? Let's see the working note. Equity shares in Sham is equal to share capital divided by face value of share. So we have 50,000 as the share capital and 10 rupees is the face value. So there are 5,000 shares in total in Sham Limited, right? 50,000 is the face value, rupees 10 is the value of share. Now Ram Limited holds how much? Ram Limited percentage stake. How much does Ram Limited holds? Ram Limited holds 3,000 shares out of 5,000, right? So how much percentage does it hold? We know to find out the percentage, we multiply by 100. 1, 2, 3, 1, 2, 3. 5 goes into 100 20 times. 20 times 3 is 60%. So Ram Limited holds 60% in Sham Limited. Okay, so we are not doing any adjustment here. On the credit side, you have sundry creditors 24,000 and 16,000. So you put in sundry creditors, Ram 24,000, Sham 16,000. Right? So we are done with this, so I've just marked it as ticked. Let me just remove these other ancillary ones because these will otherwise just create unnecessary confusions. Okay, so the first thing that I told you was we adjust or we equate or we total out all the assets and liabilities which are owned by both the companies and in which we don't have any adjustments. Done. Now the second thing is cost of control or goodwill or capital reserve. Now what does this mean? So let me first explain to you what does cost of control or goodwill or capital reserve means and when does it arise. Now there is a buyer, which is Ram, there is a seller, or rather the shares of the company, which is Sham. Now whenever a person purchases the shares of another company, right, whenever it makes an investment, the first thing which is there is the investment value, right, or the cost of shares. If we see our case, we are told that 70,000 is what Ram Limited has spent to buy 3,000 shares of Sham Limited, right? So let me just put it here. So the value of investment is 70,000. Now whenever you put the money in a company, okay, whenever the investment is done by Ram Limited and Sham Limited, in return what happens, it gets certain shares, right? So the first thing that Ram Limited gets is the face value of shares, right? Plus what it also gets is it gets share in profits. So let's say in the balance sheet of Sham Limited there are some profits, okay, which we are given is 20,000. When on April 1, 2011, when Ram had acquired the shares of Sham Limited, right? So there was a profit which was standing in the books of Sham Limited, 1st April 2011. Now when Ram invested 70,000 rupees on 1st April 2011, what it got was face value of shares. How many shares did it buy? It bought 3,000 shares of rupees 10 each, right? So effectively what it has got is face value of shares as 30,000, right? Plus it gets share in profits of Sham Limited, or as the case may be, if there is a loss, then the loss is also. But in present case it is profit. So just to avoid confusion, I'm just removing this loss situation here, right? What is the share in profits of Ram Limited? Ram Limited got 60% stake in Sham Limited. So whatever profits are there, it gets proportionate share in these profits also, which is 60% of 20,000, right? Or in other words, it gets 30,000 of face value of shares plus 12,000 as the share in profit, or 42,000 worth. Now whenever you make an investment, okay, let's say you invested 70,000 rupees, but what you got was only 42,000, right? So what has happened is you've paid more, you have paid more, but you've got a lesser value. So the difference between the amount paid minus value received. Now there can be two situations. This can either be a positive amount or a negative amount. If it is positive, what does it mean? It means I have paid more while the value I got was less. Therefore, whenever this is the case, we say that the balance amount that I have paid is on account of goodwill, right? In this case, how much did I pay? 70,000. How much did I receive? 42,000. So what's the difference? That difference is the goodwill, 28,000, right? Whereas had it been that instead of 42,000 I would have got a value of 114,000, then the difference between this and this, which was 44,000, would have been a capital reserve. We will see some examples on this capital reserve, but in this case what has happened is I have paid 70,000 while I got only the value for 42,000. So the difference is a goodwill which I have paid, which is for 28,000. So these goodwills are basically reflected in the consolidated balance sheet on the asset side. Now you must be wondering, what is the idea of computing this goodwill and all these things? The idea is that, you know, in a consolidated balance sheet which you are preparing for Ram Limited, you can't have same items. So what we do is that this investment is basically broken up, okay, and the value of the investment is correspondingly cancelled out with the share capital, right? So let's say we've got the value of goodwill. The next one, profit allocation. Now we've got a particular profit number which is 20,000, right? So let's understand the profit allocation. This normally is known as analysis of profit. Now what does this mean? So basically the total profit and loss in the books of Shyam Limited as on 31/3/2012 is 30,000, right? Now this 30,000 comprises of two parts: profits prior to date of becoming subsidiary and profits after becoming subsidiary. In our example, profit before becoming subsidiary were 20,000. Total is 30,000. Therefore, obviously this number is how much? 30,000 as on 31/3/2012. 20,000 as on 1 April 2011. Therefore, between these period 31/3/2012 and this, what is the profits which are earned? 30,000 minus 20,000 or 10,000. Now you must be wondering, why is it that I need to break up this profit number of 30,000 into 20,000 and 10,000, or profit prior to becoming a subsidiary and profit after becoming a subsidiary? The reason for that is that whatever profits you earn prior to becoming a subsidiary are capital profit for acquirer, and these are the revenue profits. Now what is the difference between these two? The difference between these two is, while the capital profit is effectively considered as a part of investment and therefore adjusted to calculate goodwill, revenue profits basically are part of profit and loss account of Ram Limited or the acquirer, right? Now considering this, let us now see the balance sheet. Now basically what do you have? You have certain items which are left behind, okay? The first one being the investment. Now this investment of 70,000 has been broken down into two parts. One is the goodwill and the other is the share capital. Please note that every entry has equal and opposite debit or credit. Every debit or credit entry has an equal and opposite impact by means of another. So if you notice your balance sheet, what all are we left with? One, share capital of Ram Limited. This is no problem. You can just write it here as share capital 75,000. In a consolidated balance sheet, you do not give any impact to the share of the other one. This is adjusted otherwise, which I'll just show you. Profit and loss account of 50,000. Profit and loss account 50,000 plus, I will come back to what is to be added here, right? Now the items which are left behind for which we need to make an adjustment are these three, right? So let us see what them one by one. So the share capital of Shyam Limited represents two things. One is basically owned by Ram, which is 30,000, and the balance is owned by the outsiders. These outsiders are classified in the financial statement as minority shareholders. So how much do the minority shareholders own? They own 20,000, right? Similarly, the investment which is there in the books of Ram Limited is on account of three factors. Share capital, which is 30,000. Okay, now this is coming on the debit side. This is coming on the credit side. Goodwill of 28,000, which we have cancelled. And then there was capital profits. 12,000. This is what we had calculated here, right? Okay, coming back to the example. So on the debit side, you had 70,000 of investment, which comprises of 30,000 of share capital. So we cancel out this 30,000 with a share capital amount of 30,000, right? This balance amount of minority interest of 20,000, what we do is we have to calculate as to what is the minority interest. Minority interest basically represents how much is the value which a company owns to the outsiders, right? So minority interest has to be calculated, which comprises of share capital 20,000. So basically again the share capital is cancelled. This goodwill in any case we have reflected in the books. Plus they own some shares of some part of the profit. The profit which they own comprises of obviously the capital profits and the revenue profits. How much does the minority owns? We know that Ram Limited owns 60%, so the minority obviously owns 40%, right? So capital profits, what were the capital profits? 20,000. Revenue 10,000. Minority owns 40% of 20,000, which is 8,000. 40% of 10,000, which is 4,000. So minority owns 32,000. So this 32,000 is basically coming as a liability. Why? Because this is something which is owned by Ram Limited, or as you have consolidated the assets of Sham Limited in your books, the proportion owned by outsiders is shown as a credit by way of minority interest. Right? Now the last bit, which is that out of this revenue profit, 4,000 is owned by minority. The balance belongs to Ram Limited. How much does Ram Limited own? It owns 60% of 10,000 or 6,000. So this we are going to add to the profit and loss account. This will give you 56,000. Okay. So let's do the total of these two. 50 plus 45, 95, 140, 175, 195, 203. Again, 2 and 6, 8 and 5, 13, 3, 1 carry, 8, 5, 13 and 7, 20. So we are done with the balance sheet. Right? Just to recapitulate, there are certain steps that needs to be followed. The first one is whatever unrelated assets and liabilities are there which are not subject to any adjustment, just add them and put them in the balance sheet. Calculate the cost of control or goodwill, which is calculated as the amount of investment less whatever values you have received. Then there is a profit allocation. So whatever profits are earned by Sham Limited or the subsidiary, they have to be allocated between the holding company and the minority. Okay, the interest of minority has to be reflected on the liability side. This basically comprises of the share capital they own plus their share in revenue and capital profits. Once this is done, you can add on and complete the balance sheet.